the annual revisions have been negative. They were negative last year. I think they might have been negative the year before, and we're probably due for another big negative one this year. I don't want to say that I'm glad to have these revisions. I just recognize that this is not an easy problem to solve. There's all these huge things happening and they're pushing into each other. Maybe it is that the demand side effects of the tariffs are going to really start kicking in. That's one possibility. The other one is, by the way, the immigration squeeze is ongoing. My gut is still that the weakening impulses will eventually kick in.
This episode is brought to you by VanEck Semiconductor ETFs. You'll hear more about the VanEck Semiconductor ETF, ticker SMH, the largest semiconductor ETF, and its newer VanEck Fabless Semiconductor ETF, ticker SMHX, later in the show. The Blockworks Digital Asset Summit, crypto's premier institutional event, is back in London this October 13th to 15th. You've got top speakers from BlackRock, Circle, Coinbase, the UK Parliament, and Athena, all under one roof. I'll be there as well, hosting a live forward guidance episode with Quinn and a few others. So if you want to see us record in the flesh or meet some of the other legends from the forward guidance community, this is your shot. Notable macro names like Michael Howell of Cross Border Capital and Jeff Park are already confirmed, with more coming. There's also a VIP dinner on the 13th that will sell out fast. That's for speakers and VIP ticket holders only. It's at Old Billingsgate in London. Use code FORWARD100 for £100 off. See you there. Nothing said on forward guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, everybody, welcome back to another episode of Forward Guidance. And joining me today is Guy Berger, Senior Fellow at the Burning Glass Institute, a well-renowned labor market economist. I've used many of his charts before in the weekly roundup that we do anytime I'm looking at the jobs report or labor markets and initial claims, anything like that. First thing I do is go check out Guy's work. So Guy, it's an honor to have you on the show finally.
It's an honor being here. Thanks for having me, Felix.
Super excited. So, okay, we are talking at a time where it feels like there's a lot of cross currents happening in terms of labor markets, labor market data, how it's gathered. We're recording this Tuesday, August 12th. We just had the announcement of the new BLS commissioner that Trump is nominating to be confirmed by the Senate, E.J. Antony. So it's a very timely moment right now to really set the stage for a 101 style of just really understanding labor market data. How does it work? How does the sequences of all work? So yeah, nobody better to help us walk through all of this than yourself. So, okay, with that said, I want to start our journey with the NFP, otherwise known as the jobs report. So obviously a lot of this is done with surveys. There's the household survey, the establishment survey, then there's also the challenger survey over there as well. So would love to just start by just getting us to understand the process of how does the BLS actually go through and gather the data that it requires for these monthly job reports?
Yeah, so you covered the first half, which is there's the household survey and the establishment survey. They go in the jobs report. The household survey is where you get data like the unemployment rate, the participation rate, prime work age, employment population ratio. There's some other stuff in there. It comes from called the household survey, but it's like the official name is the current population survey. They call people households on the phone, and they just ask them how old are you? How many people you have in your household? They ask a bunch of other questions, but they also ask do you have a job? If you don't have a job, you're actively looking for one, et cetera. And a lot of these data come out of that. And then there's a second survey that's the establishment survey, where essentially businesses fill out forms and they tell people. And when you say businesses, we used to think about firms, but these are establishments. The idea is it's like a work site. So it can be an office complex, or it can be a construction site. So for example, Amazon is it'd have a bunch of establishments to pick in one company. And there's a good chance, by the way, that in the case of Amazon, different establishments are in different industries, because there may be people that are sort of in information services because they handle servers. And then there's a part that's maybe non-store retailer, and then transportation, just giving a sense that this is a pretty rich thing. And those companies tell them, this is how many employees we have, how many hours they worked, what we paid them in average, in pay, and which allows you to calculate things like the average work week and the average hourly earnings. And then zooming out, I think the key thing, and I think what's controversial, and the non-farm payroll employment estimate comes out of that survey. what happens with the establishment survey, but not really with the household survey, is you get these revisions. First, the monthly ones, 2 months after the 1 and 2 months after the initial release, and then on top of that, every year you get a big annual revision. That's itself a complicated thing that we're probably going to talk about later today. Now, I think what's sort of bugging people with these revisions, and we're also going to talk about this, is like, first, the annual revisions have been negative. They were negative last year. I think they might have been negative the year before, and we're probably due for another big negative one this year. And on top of it, the monthly revisions recently have tended to be negative in the sense that number will be released, then on average, it'll be lower 2 months later. I think that in particular, the most recent ones, they were just very large in absolute terms. I mean, there were some charts that were saying it was the biggest since date X that didn't adjust for the size of employment. And I'm not really a big fan of that kind of approach. I think you do want to scale it, but they were big in the sense that they did change people's I mean, there's no denying that they changed people's perspective on what employment growth had been recently. And unfortunately, that happens. And there may be ways we can improve that I'm glad to discuss. But part of it's just trying to get a more accurate picture. I mean, would we rather have that there were, that in the case the numbers are wrong, they just stay wrong? Like, I think it's sort of the nature of timeliness versus accuracy that exists.
So, okay, I think that catalyzes the first burning question for a lot of
Yeah.
folks, which is, it's 2025. We have AI, we have all these technological innovations. Why do we have revisions in the first place? And to answer that, I would love to just better understand like the statistical process involved with this survey data. And why is it that the initial pass, it's expected to have revisions? And then the second question associated with that is, yeah, what are normal revisions, quote unquote, and why is it that it gets more accurate over time, and why is it that we get this more blunt number up front, and then it gets more accurate as we go forth? Like, what does that process all look like?
Yeah, sure. So the first thing that, let's think about it this way. One thing that could be done theoretically for like talking science fiction is that in fact, somehow we set up every business, including like pretty lo-fi businesses. Like, I mean, I'm going to pick something like there's like a food truck in the corner, and there's like that you probably operate. Some of them still operate with like physical cash registers, and we set them up with some sort of like super automated system, and either it, regardless of what they choose to do, just sends information to DC. And by the way, this would not just have to do with how many people they work, but also how much they pay them, how many hours these people work, and just sends it automatically. And that would be, and then by the way, if they don't, or if it gives them some leeway, but if they choose to opt out, they get penalized in some ways. Like it becomes mandatory. Like we both sort of come up with this kind of stuff, this idea of like almost like a monthly census of this data instead of a survey. Like there's a cost of implementation. Like how do you get, it might be expensive for people to do this. Is the government going to do it? Are you willing to enforce it, to require essentially be like a panopticon where for this kind of data that you just can't get away from reporting it? I think once you start thinking about that, you start raising questions of how realistic would this be. So let's back up, because I think that's sort of it. The idea of having the early data is you have a survey of just a certain number of establishments, instead of making everybody do it. To lower cost of collection. There are things you could improve in general, which we can talk about. But I guess I want to start with that. Now, I think that realistically, when revisions come about, there's two sets of revisions to think about. The first is what we think of as the early revisions. The BLS sends out these forms. Some firms respond promptly. Some firms take longer to respond. They will tell you, if we're collecting, we just had the June report, we're coming up on the July report. They might not tell you what their payroll looked like in June until August, in which case it's going to come out with the September report. It's like response rates have been falling over time, and particularly early responses. And as a result, you're just getting less accurate numbers early on. Now, I think one argument should be, let's just wait. I mean, and there are going to be issues that come up with it, even this approach, but like, let's say wait 2 months. I'm not a big fan because generally I think they're obviously revisions, but there's usually a pretty good correlation of the early number and the eventual number. So essentially, like, I think it is valuable to have a blurry signal. We already know, by the way, since people invest a lot of energy in things like, other wonderful providers like ADP and Indeed and, my old employer, LinkedIn, that does this awesome LinkedIn hiring rate. we know that like people are really interested in this data. If suddenly the BLS sat on it for 3 months, it's not like we'd be like, okay, we finally reduced this imperfect noisy signal. We were replacing it with an even worse set of signals. I mean, all these are wonderful, but they're not substitutes. And so I think that's sort of my perspective on that. Now you get these late responses; they change the numbers. The other thing that happens that is less discussed, and this is really sort of an inside baseball thing, is the BLS recalculates seasonal adjustment factors every month. And sometimes the revision comes from that too. I mean, if you will look at it, you would see there's a revision to the non-seasonally adjusted number, and then there's the revision to the seasonally adjusted number, and they're not quite the same thing. And in the end, in the employment level of like 160 or 100, whatever million it is, like these things from that perspective look tiny. They seem big from the monthly change, but the reason I'm throwing it out there is like these are things that normally a lot of other indicators just wouldn't even necessarily cross your mind that much. And here the numbers, just the way we are used to looking at them, the changes seem big. But so that's one set of revisions, is like what happens to the most recent data. Then after like 3 months, they freeze them. There's a second set, and by the way, this is why delaying the report by like 2 months, which I think is a bad idea. Like, even if you were to do it, like to do that, you would still have potentially substantial revisions later on. There's the issues with the BLS as sample, like for the establishment survey, the BLS as sample. Businesses die. So you hear about the net birth death model. It's always like was some sort of demographic thing. No, it's about businesses. Like businesses shut down and they stop responding to the BLS. Um, Businesses created and the BLS is slow to add them to the sample. I mean, just if the business created, you don't know about it right away. And as a result, they try to model that. What's happened, and this, by the way, historically has led to revisions over the years. You can look at a history of revisions. Some have been very large, some have been smaller. The revisions tend to be pro-cyclical in the sense that when the labor market which is not surprising if you think about the distribution of births and deaths, like the BLS will tend to be slow to register accelerations in the economy. So when the economy is starting to accelerate, payrolls typically get revised up a year or a year and a half later in the annual revision. And when the economy is slowing down, they tend to be revised down. Now, I think there's two parts of this that I think are particularly relevant to this. So one, there's a description of why we've had negative revisions in the annual revisions, and we're getting more. And the other one is just in general in terms of the size of these revisions. One thing that's changed post-pandemic, we talk about low response rates. The amount of churn due to birth and death has gone up since the pandemic. So if you think about this in terms of what parts the BLS is effectively collecting data on in real time versus what parts it essentially has to model or guess what is going on, it's gotten harder. Like the more of your employment, and if you all of your employment in real life and like the real true number, if all of it's coming from businesses that exist in a very undynamic economy, the BLS might actually do a really good job and revisions would be minimal. If all of a sudden there's just churn, there are a lot more businesses dropping out of your sample because they just don't exist anymore. And there are a lot of businesses that should be joining your sample, but we don't know about them yet. You're going to start kind of having to, for the modeling chunk of this is going to increase. That's happened. So if you are going to want to fix that, you are going to need to be able to model in a balanced way what's going on with the data better. The second part, and this is sort of what direction of it, we've been in an environment where like that's actually quite unusual by historical standards. Usually, like the way business cycles work is the economy falls off a cliff in a recession. It can be a mild recession like in 2001, or it can be a serious one like 2008, or it can be something bizarre like COVID, where essentially most of the economy shut down for 2 weeks, then reopen. But I think the reason I mention this is like it sets up that you don't usually get this very long extended sequence of downward revisions. Instead, what we've had, by the way, over the last 2.5, really 3.5 years, because I think the peak labor market heat was like sometime in very early 22, late 21, is just a very slow, gradual cooling. So essentially, like every year, like the underlying mechanism of job creation is a little colder, and the BLS essentially is like failing to anticipate that. Should they be anticipating that? I mean, at some point, like we can debate on maybe they've been too optimistic about their assumptions. I mean, if all of a sudden they became way more pessimistic and the economy stabilized, maybe it does. I mean, some indicators just that the economy is stable, then it might be that in fact they start undercounting job growth. Like my feeling is like my sense on this is it'd be great if they had better indicators to improve this. They should be resourced to explore this and to improve it because I think it is worthwhile. I don't want to say that like I'm glad to have these revisions. I just recognize that this is not an easy problem to solve. And by the way, that some of they've implemented solutions in the past to try to deal with this stuff. It's just hard. I think that my point being that this is the fact that the economy has been cooling sort of semi-continuously for like 3.5 years, maybe stabilizing recently, maybe stabilized recently, now starting to cool again, like makes catching these turns harder. And we've just essentially been like, there have been like three turns in a row in one direction instead of what typically happens, which is maybe you have 1 or 2 years where you get negative revision, you fell in a recession, and then next year is like a positive one because the economy's in recovery mode and reaccelerating again.
Breakthroughs begin with semiconductors. With over $23 billion in assets under management, the VanEck Semiconductor ETF, ticker SMH, is not only the largest semiconductor ETF, but it has also outperformed the next largest semiconductor ETF. It is built on an intelligently designed and constrained index that includes the whole sector stack, from design to manufacturing. Historically, this unique construction and methodology have helped SMH outperform its closest ETF competitor. Check out the table below. Go to vaneck.com/SMHFelix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. Distilling all of that, it feels like for market participants or investors that are trying to form an opinion on whether these amount of revisions we get, are they within the standard band of deviations, or are we seeing an outlier in the last couple of years? So it sounds like the three vectors are seasonal adjustments, birth death model changes, and then just this iteration in the narrowing of the
Responses.
confidence interval. Right. Yeah. And then just this narrowing of the confidence interval from the initial survey where, correct me if I'm wrong, but they target around like a 90% confidence interval, which leads to like plus minus 100,000 jobs. And then as that progresses, it gets more accurate.
Yeah, I mean, I think that the way I would think about it though is even those final numbers, like, and I think this is a good thing in data. Like, in the end, and I guess I would tell this as somebody like it's not how the BL should publish it, just about how you should think about this data. Like, it is a good habit always to not look at one piece of isolation because either it could just be an outlier at any point. If you look at all the constellation of data, if you were a kind of person, we know this because there's ongoing debates. If you want to be a doomer, even in the report, you could find the single worst point, which might even be worse than payrolls. I'm sure you could find something else in the report that was worse than payrolls. Um, if you were a doomer, you're just looking at temp employment forever and ignoring everything else. You could also be a very upbeat person and pick like the single most upbeat part of the report, and then it'll broaden into a constellation of data, other indicators. Like, my feeling is like, don't overindex on a report. Don't take any data point like too, setting aside even revisions. Don't take it too literally. Like, my feeling is like, the fact that payroll growth is average 35K a month is probably like an okay reflection of what is going on directionally, but like there could still be an overcount. I mean, I think that just generally like be humble about like how certain you can be based on this data. If the payroll report, if heaven forbid what the BLS commissioner says, so they're going to discontinue the monthly jobs report, I really, really hope this does not happen. If they do it, you're going to have to be doing this with other stuff too. Even data that doesn't get revised. If a data doesn't get revised, you still can't be sure it really tells you what's going on in isolation. Um, and I just encourage people, just generally as good data analysis hygiene, like to not just take every data point literally, not follow sentiment to up and down when you have a good number. When a good report does not inherently mean the economy's all of a sudden turn the point to booming. When you get a bad report like last month, and it was a bad report, even outside of non-farm payrolls, it doesn't mean the sky is falling. I just think it's good to be judicious. It may mean, by the way, they're going to be slower sometimes. And maybe you have a view that you're like, this month, I really believe that number. Fair. I mean, like, again, I'm an economist. A lot of people listening to this are actually market participants. And so I get that. You need more of a strong view. But just realistically, that is more in position on your guess of where things. I would also be clear about what it is. You're like, this is about your guess of where things are headed and less about what this specific number contains. It's like you're kind of extrapolating out a signal that you're detecting from it. I just think that humility of the numbers, not taking the numbers too literally, true of every data set, not just the BLS report, not just the non-farm payrolls, is a very good habit or good starting point.
So it sounds like the way to net this all out is to be intellectually skeptical of the initial numbers, like validate them and
Yeah,
dig
you
deep,
should be
but
initially
understand
skeptical.
that but that we are within a realm of normal variance in the data. Like there's no weird things happening.
No,
Is
I
that
don't like.
correct?
Let me say it this way. I think that just generally, the way I would think about it, based on what we know now, is it's very reasonable for you to conclude employment growth has slowed in the past, certainly in the past year, maybe in the past few months. Certainly, very conceivable it's in the past few months. It's sometimes hard to tell too because the way the data works is like it gives a sense of timing that does not always correspond. Like that's why some indicators will all move in the same direction but kind of lurch out of sync and then rejoin. Is like there's not a so. But I think it's fair to conclude from this data that payroll growth has slowed sharply sometime over the past year and probably more recently, and that's actually been slowing for longer ever since the big immigration boom started winding down in the second half of 2024.
Yeah, I'm curious about that immigration dynamic. Let's use that as a catalyst to use what we just talked about to compare to this latest jobs report. So, okay, we've had this huge surge in immigration in the last couple of years, and now the complete reversal. And my first question is just around how do you look through that pass through into the data? So we've obviously seen the labor force participation rate dwindle down, and now you've had this interesting situation where just in this recent report, we've seen an unemployment rate that's stayed pretty low compared to what's going on in these major revisions in the non-farm prints. So yeah, what's the right way to think about how immigration is affecting this data?
So the first thing is, and it's funny because it's been very under discussed, and I'm hesitant to bring it up because I don't want people to freak out, but it's actually like estimating the population is one of the hardest things that that the government, the Census Bureau, has to do. The BLS basically is relied on census estimates, and in fact, like given that the administration is talking about doing certain things with the census, I don't know if they'll be able to do it. Like, could be even more of a problem, right? Like but I think that's sort of the reason I bring that up is the BLS conducts census every 10 years. You have to guess. And when I say guess, I mean educate, I guess. You have to estimate what is happening in the interim. And part of the problem is that data, the census every 10 years. You're going to wait 10 years to get an accurate estimate. You're not. You're going to have interim sources that are of decent quality. And then for very recent data on population, you're guessing. Like you literally have there's projections. It's a model. So it's not like they're just like, oh, I don't know. But it is like the recent population data gets shakier. And what we saw early last year is the BLS finally updated or the Census Bureau updated and concluded, in fact, that not only were they undercounting population growth in 2024, but in fact, several years back. So we got this big jump. If you look at some of the household survey series, like the level of employment or level of labor force and level of employment, or even the level of unemployment, they all got like a big jump up because it was implemented in one shot in the BLS data. And the reason I mention this is like right now, census models are assuming slower population growth underlying it, which, by the way, does not go to non-farm at all. Like non-farm, we talk about slower payroll growth because of population growth. That has nothing to do with census estimates. They don't use it. It's just consistent with that. We actually don't fully know how much the population growth has slowed. We have the census projections, but it could be those trying to be wrong. Maybe they're actually now, after several years of underestimating population growth, they're overestimating it because they're slow to adapt to how aggressively we clamp down on immigration. Maybe deportations. We don't have great data on what is going on there, but maybe they're bigger than people think. And in fact, it's possible that population growth or labor force growth or potential labor force growth really has ground to a halt. We don't have a really good idea on that. We can guess, but I think there is a very good reason to think that population growth has slowed. And so we're in this world where labor force growth is slowing because our population is aging and we're letting fewer young people in across the border. To keep what's in the denominator of the unemployment rate, it's the labor force. And so if you're adding fewer people, then to keep the unemployment rate steady, you need to add less to employment each month. And if you're growing the labor force very slowly, then that number, I mean, theoretically, by the way, if at some point we still have very low immigration and the population is aging a lot, it could even be that negative payroll growth, negative employment growth instead of the steady unemployment rate. I mean, like I drew this analogy somewhere of like, look at Japan, look at Southern Europe. These are countries with an aging population, the prime working age, native born population is not growing. In some cases, it's shrinking. And again, they have, in some cases, quite tight labor markets in a world where like they're not adding net jobs. And I think and the reason I mention this is it's sort of this, we're used to our framework always think about these numbers as big payroll number, strong job market, weak, low payroll number, weak job market. And I think we have this force here that is causing that to change in a way that is not tied to like what we think of as the labor market strength in the sense of slack. So to pick an example, during 2023, right up until at least early 24, we had big jobs numbers. They got revised subsequently, but like you still look at it and those numbers are in the 20 teens would considered like solid. In some cases, their numbers were more than solid, but like again, it's a decent run, and the unemployment rate headed up. I mean, there were some periods where the unemployment months where the unemployment rate headed down or stable, but just generally, there was a period like that's when we triggered the SOM rule, right? And then there were some revisions on this debate whether the SOM rule was ever triggered, but like the unemployment rate went up by a lot during that period. Now all of a sudden we have a bad jobs report, but it comes in the context of the unemployment rate being pretty stable. It it was at 4.2 something, or about 4.2 in July of 2024. It's now at 4.2 again. And maybe we're in the start of a new uptrend, but just generally it was flat for a year. And the reason I bring that up is like we're sort of in a world of lower job growth, but the unemployment rate not zooming up. And I think that labor supply and immigration is the big story, I think. Again, it does not, there's some debate over whether that's what's caused unemployment to stabilize. But just saying, in terms of that relationship between the trajectory of the unemployment rate and non-farm payroll growth that we thought we had coming in, it's repeatedly been like thrown off sides by labor supply growth, first zooming up in 2023 and early 24, and then crashing since the second half of 2024.
Is the right way to characterize this that, okay, you have labor supply coming down, but you have labor demand coming down at a pretty equal rate? And if so, like what is the net impact of that?
Yeah. So first, I think a boring answer. I felt good when Chair Powell said this because I've sort of been playing around with it as well, and he's obviously much smarter than me. So I felt whenever somebody smarter, more famous agrees with me, I feel good. But jokes, levity aside, I think it is a good way of thinking about it right now. I would not view it as like some sort of permanent state of affairs. And I think that's sort of it. It's like so far, yes, that's what sort of happened. I share this gif from like I think one of the Naked Gun movies of Leslie Nielsen saying nothing to see here while things are blowing up. I think the point is there's nothing to see here if you're just looking at unemployment in isolation. Meanwhile, there's all these huge things happening and they're pushing against each other. If they've offset so far, it does not mean they're going to keep offsetting each other durably. Like maybe it is that the demand side effects of the tariffs are going to really start kicking in, and so July's report, which was bad, is followed by an August report that's bad, and a September report that's bad, and all of a sudden we find ourselves with an unemployment rate north of 4.5% by the end of the year, maybe even close to 5%. That's one possibility. The other one is, by the way, that we sort of talked about is like the immigration squeeze is ongoing and has the potential to get worse because we are still to some extent in the process of absorbing like that big boost of labor supply. And what if it turns out the labor supply squeeze is so strong that we are potentially dealing with a tighter labor market a year from now? A small, like essentially a low employment growth, but like tighter labor market. It's not my base case, but is it outlandish to think this could happen? No, definitely don't think so. And it's hard because again, what we're sort of, Jed Kolko has some and other people and Stan Voiger and Wendy Edelberg they've all done like these amazing estimates of what they think the break-even payroll number is. People ask me like, what do you think the break-even payroll number is? These things are hard to actually estimate with precision because so many things underlying it, like there's the birth death model that can affect that estimate. Census population estimates will change it because if census population estimates are too high, then that means the payroll break-even number will naturally actually be lower than we think. But the gist is just it's lower. And I think that these forces push against each other in terms of labor market slack, but they're both pushing payroll growth down. And I think that is unusual because in a normal business cycle, we're really used to is, well, payroll growth is slowing. That's because demand growth is slowing. And, the labor market can no longer absorb, employers can no longer absorb the growth in the labor force. And therefore the unemployment rate's going up or the share of prime mortgage employed people is going down.
Using a similar philosophy to SMH, the VanEck Fabless Semiconductor ETF, ticker SMHX, goes even deeper, exclusively investing in fabless semiconductor innovators designing AI infrastructure behind the scenes. We're talking high bandwidth memory, power management chips, custom accelerators, and ultra-fast interconnects, the critical components that make large AI models run faster, smarter, and more efficiently. Go to vaneck.com/SMHX Felix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. Okay, so let's continue our journey into unpacking this toolkit that we have at our disposal. So we've talked about the NFP and all of that associated with it. Let's shift into claims data. So jobs reports come out every month. Claims data is every week. You have the initial claims, the continuing claims. How do you think about the two? What's the right way to think about it? What are some other more granular details that you look for in those data points every week?
So the first thing is, I love the claims data. I wake up early every week. Someone said, I'm here on the West Coast with you. So like it's early. I hope
Yeah.
you're still asleep when it
I'm
comes
early
out.
with you as well then every
Oh
Thursday.
man. So it's early, but it's
Yeah.
worth it because sometimes there's something fun in there. The first thing that I guess I'd say that I think probably all people listen to that watch this podcast know, but in case you don't, like there's some people are like, oh, the claims are from BLS. They're not. They're actually from a totally different part of the Department of Labor, the Employment and Training Administration, and that Employment Training Administration doesn't actually like collect the data. It compiles data that's collected by the states. The other thing is that unlike the BLS monthly report or the JOLTS report, these aren't surveys. These are just like raw counts. This many people claimed this month. This many people are eligible to claim, which is it's called covered employment. It's usually not a stat people pay attention, but comes out every month. This many people are still like the continuing claims data. These are just literally counts. They get revised sometimes because the DOL has to estimate their estimates. They sometimes wiggle. These estimates tend to be let me say it this way. These revisions tend to be, in general, smallish. Like, it's not like there's no benchmark revisions to claims. Like, data from 6 months ago is not going to change. Sometimes there have been weird situations where, like, states somehow screw up the calculation or something like that. It happens. It's a risk, but it's not common. So usually the revisions you get are, like, based on estimated data from some state, and they get tweaked shortly thereafter. So let's start with that. And so again, it's different in the sense that it's not a survey, and it's the revision. There's also revisions to the annual seasonal adjustment factors. I actually think personally that there's some residual seasonal adjustment factors not doing that great right now, and so potentially that could change the way the series looks. But like, I think seasonal adjustment revisions tend not to matter as much because the underlying data is kind of not changing. So like, it's a low second order revision, not a first order one, which is like in NFP where we're like, oh my gosh, we just like underlying it assume like there's no like we assumed there were X thousand jobs that weren't there, or we suddenly discovered under the mattress there were more jobs than we thought. But that's the context in which the data comes out. There's really two big chunks that people pay attention to, and they're proxies to different things. I think it's actually useful. One is initial claims. This is a proxy for layoffs. The idea is, that, and historically it's been the case that, when people get laid off, that is a key that usually determines the eligibility, because if you quit your job, you usually are not eligible to claim. You lose your job, you're actively looking for work, then you can get unemployment insurance. And so that's why it's a layoff proxy. It is not perfect. There have been lots of points on why it is lower than it would have been at a similar point in the cycle in the past. I mean, some of it's like the gig economy, is it worth it? Like, which, by the way, I don't disagree with inherently for why the level over a long period of time be lower. There are also restrictions. It's gotten harder. The economy's changed in ways that has made it less likely. Like, essentially, it used to be there was a lot more churn having to do with the manufacturing sector. Just in general, it seems like demographically, like long run, layoffs are trending downwards. Maybe one of the reasons why layoffs are low now is less of a cyclical thing and more just of the labor market changing structurally into fewer but more durable layoffs. But regardless, that's one. The other big point of data, it doesn't cover everything.
Before you get into that, I just have one quick question on the gig economy thing. To validate and track that thesis, would you look at an uptick in employment for part-time reasons to tick up there to track that?
I mean, so it is true. Like, I think it is possible that the drift in unemployment for it could be that part-time work is an example. If we see it for like economic reasons, which has crept up a little bit over the last few years, etc. I mean, it could be people working more than one full-time job. Like, there could be, like, my sense is that, for example, we've seen there's now more people working, I'd have to look at the specifics, but like, fluctuation of people working more than one job, like indicative of this. But the reason why I'm sort of like I'm more skeptical of this argument, by the way, because I've heard it, is Fair enough. That's a reason for why initial claims, if you compare them to like a few years ago, would be the case. It would not explain to me why all of a sudden initial claims would fall in like the span of a few months, right? It's not like the gig economy suddenly like expanded by a lot. And I think when I think about claims, I'm mostly thinking about these sort of short-termish, as in like a year and a half fluctuations. Like I have a very strong conviction. If we were to suddenly see a big surge in layoffs, yeah, some of those people would not claim. They'll go to the gig economy. But some chunk of them would, in fact, claim, and we would see initial claims go up. And so I do like, again, to me, it's kind of that's sort of that argument is very plausible. They're very, again, like the thing of like people compare initial claims to like what they were in like the 80s or 90s or 20 teens. I don't think that's fair. I don't think that is an like people shouldn't be doing that kind of comparison. There are other better indicators for that kind of comparison. Claims is not it. But like for like the last, the fact that initial claims have suddenly dipped could be noise. I actually think it's well within the realm that there's something weird going on. It's temporary noise and they're going to bounce back. Fair. Or all of a sudden the wave of layoffs will come in and then they'll go up. But I don't think that like these sort of structural explanations, which may have some validity, can explain what claims have suddenly fallen.
Okay, that makes sense. And then you're going to explain continuing claims next.
So continuing claims is different. Initial claims is a flow. It's how people claim for the first time. Continuing claims is a stock. It's like how people are claiming at the present time. And this has sort of historically been used as a proxy for the unemployment. You can use there's something called covered employment, which is how people are eligible, creates a denominator. And then you can use that ratio, it's called the insured unemployment rate, continuing claims divided by covered employment, to generate the insured unemployment rate. And historically, people have thought about it as a proxy for the unemployment rate. And it tends to be actually when things really are heading south and the unemployment rate is spiking up, it does tend to functionally be it. However, what's important and I think has mattered during this cycle is not unemployment is actually composed of a lot of things. There are people that are unemployed because they just quit their jobs. They're job leavers. There are people that come into the job market for literally the first time, new entrants, like people that graduate from high school. Some cases, people that graduate from college. They're re-entrants. Some of these are people that are, actually had a job before college and they didn't work while they're in college and they come in and they're actually not new. It's weird, but they're actually, I learned this at some point in the past year and it's surprising, but it's like they're actually re-entrants because they have worked before. But some re-entrants are people that, maybe they collected severance and after 6 months it runs out and they file and now now they're starting to look for work again. Or maybe like they got discouraged or something happened in life and they stopped looking. Maybe their parents that were on leave that left the workforce and are coming back. There's re-entrants. And then you have people that actually lose their jobs for a variety of reasons. There's people that are on, this used to be a really big thing that is much less of an issue. It caused a little bit of a weird freak out of the job market, I think last summer, which was temporary layoffs. That's the idea that actually was really big in COVID and then was really big in the 60s and 70s, which is your work site shuts down. You don't have a job, but you expect that at some point it's going to reopen and you'll be called back. And then you have people that finish temporary jobs, and you have this big chunk that is actually like tends to be the most recessionary of all, which is due to permanent layoff. That's the idea that you lost your job and you don't expect it to come back. Like essentially, you really don't have a job. It's not like you're temporarily out of luck with a job that's going to come back. And this has been in the last few cycles, leaving aside COVID, the big force in causing unemployment to go up. And it's been over the past 2.5 years, it's crept up a little bit. What's weird is actually behaved, during that period where unemployment rate was like moving up last year, it was actually not a big driver, which was, I think, weird and interesting. Yeah. And the worst part of it actually happened when unemployment was still relatively benign in 2023 and early 24. But the reason I bring that up is my sense is, again, claims do partially correspond to like the temporary layoff. People on temporary layoff can claim it. It's just that number is not moving that much. And people who lose temporary jobs typically are probably also, I guess the eligibility rules vary. And then some states are just generally more generous. So maybe there's some other stuff. People sometimes can claim, I'd have to look at exactly where it is, but there's a separate line item, I think, for work share. When you hours, sometimes some states are eligible. But I think the continuing claims number just literally is probably likely to correspond to that hardcore unemployment thing where you're actively looking for work and you really did lose your job. And you don't expect to get it anytime soon. So you better start claiming benefits. And I think those numbers have tracked together, not perfectly, but okay, in the sense I call it like a nowcast. And by the way, it missed in June when that share of unemployment fell down and claims actually looked like they were zooming up in June. But just generally, I think that's sort of it. I think about these two parts of the claims report as like a proxy, not a perfect one, but a proxy for layoffs and a proxy for that segment of unemployment. And it's useful just because it comes out earlier. I do not think it's perfect. Sometimes, as I said, it misses, but like it's probably one of the higher quality signals, and we get it like a few weeks early. It's nice to have.
All right. So last big piece of the puzzle, JOLTS data. What's the read there? What do you look for? How does it work? Who gathers it?
Okay, love the JOLTS data. So before I talk about the JOLTS data, I'll just do a plug because actually, it's funny I'm spending so much time talking about non-farm payroll revisions. Look, I actually think that the current population survey where the unemployment rate comes from and some other stuff, like you can construct quasi JOLTS measures, and I'm really into these. They're a really nice supplement. They don't replace JOLTS, but it's nice. So basically, instead of like the JOLTS is a survey of businesses. Businesses say, we hired this many people, we laid off this many people, this many people quit, this is how many job openings we have. But like the CPS is a nice supplement to it. And basically they sing from the same hymn sheet. It's just a nice thing to have. It comes a little earlier, but it's noisier. And there are people that have developed, like there's two researchers, Amanda Michaud and Catherine Elliroth, at this awesome, like they track layoffs and quits into non-employment based on the CPS data. It's totally different from JOLTS. It's noisier and it has some other quirks, but if you're like a labor market data addict, worth checking out. There's job switching probabilities the Philly Fed, Mascarini, Postel Vinay, and Fujita put out. And you can also do some other things. I just mention it because I think that people are interested.
Mhm.
But let's say that's too inside baseball. There's a JOLTS survey. It comes out every month. The first weird thing about it, they actually moved it earlier in the calendar, but it's still like it is an older bit of history than the jobs report that comes out a few days later. So for example, we get in early August, in early September. Wait, what month are we? We're in August. So in early September, we're gonna get the August data. A few days earlier, probably on Tuesday or Wednesday, I think, JOLTS is gonna release the data for the prior month, which I guess would be July. And just something worth keeping in mind. But there's a quirk there, which is like the timing of it. JOLTS measures the entire month, whereas a lot of the monthly jobs report surveys correspond to like the period, including the 12th of the month. So like theoretically, the JOLTS data covers data of the BLS, even though it's like a prior month, includes some data that would not have registered. So for example, let's say that in a given month, hires are terrible in the beginning, and then all of a sudden they like really pick up toward the end. It's possible that you could get a really strong JOLTS and a weak NFP. Just throwing it. I mean, like I don't think it's necessarily worth thinking about this too hard, but just a good thing to keep in back in mind. So what does JOLTS do? It's a survey of businesses, a lot like the survey that generates NFP. It's a different survey, but like they're actually anchored to over time. The revisions try to smush them together. But they are different surveys. Like they're not. It's not like doesn't come out of data that's collected from NFP. It is, by the way, probably has some more annoying requests from firms because doing a simple count of employees is easy. Telling people this many people were added during the course of the month, this many people were subtracted, and then why they were subtracted, because you get asked, did they leave? Were they laid off? Were they quit? There are other forms of retirement. Like retirements, for example, don't count as quits. There's like this small other separations category that nobody pays attention to. It tends to actually move in tandem with quits typically, but is on a much smaller scale. And the way to think about all these data points is like hiring and quits are frankly, leaving aside the very extreme recessions, are nearly where all the action is. Like when the labor market's good and getting better, hiring and quits zoom up. When it's cool and they come down, and they've come down a lot in the past few years. The labor market's cool. We had crazy. That's why people were talking about the Great Resignation, because we had hiring and quits because of job hopping were off the charts in 21, 22. It's come down a lot. Layoffs tend to be like they're low right now, but they're also like very stable, and like they're sort of feeling like everybody's like, oh, when there's a recession, layoffs are going to pick up. That's not really like historically. Really, hiring drives a lot of this, and the reason is even if layoffs are low, if people that are laid off can't find jobs, that pool of unemployed people is going to creep up. That really tells a lot of the story for why unemployment has gone up in the last few years. Just that like ability to absorb from that unemployed pool has weakened because we're hiring fewer people. And so I guess I would think that if we do end up tipping into a recession, I hope not, but let's say we do, layoffs will be like the last thing to move. They didn't really get going in 2008 until like the spring or summer, and really didn't get going in a big way until Lehman hit. The economy had been in recession for months by that point. We were getting NFP numbers that were negative. The unemployment was going up. It was not a very severe recession, but it was, it was a recession. And in 2001, around September 11th, they really spiked. But like we had been in recession again for a while before layoffs got going. So again, it's sort of it. Like the one thing I think that the JOLTS report I think sort of is it's really useful for those hiring and quits data. That's what is your. I mean, the layoffs are interesting, and it's always a fun story to like say, oh, despite the headlines, layoffs are still really low, whatever. But like, I think that like what would get me interested. For example, we talked about if the labor market start cooling again. To me, if that hiring number that was a little weaker that we got in the last JOLTS report repeats, or if hiring falls down further, or if quits start coming down, like that's a bad. Like to me, that would really cement a pessimistic interpretation of where it's going. On the other hand, if they stay steady, then I'm like, and the unemployment stays steady around the same time. Like, I mean, that's sort of the key story of the labor market's actually been stable since last summer or fall, is that all these indicators kind of agree that things have not gotten worse during this period.
Yeah, they haven't got worse, but what I find interesting is, okay, once you, as a market practitioner, get armed with, you got the job vacancy data from JOLTS, and now you have the unemployment rate. Oh, look, you get the Beveridge curve, which is this curve, for those that don't know, that you can sort of track the sensitivity from, or like how much slack is available in the labor market. And what's interesting is that at the beginning of the hiking cycle, Governor Waller talked a lot about how he felt that there was a lot of room for them to hike and be quite aggressive because of where we were at in the Beveridge curve. And we'll have the Beveridge curve up here when we're talking about this. But you could see that he felt that we could really tighten things up until we hit that like 4.5% level on the vacancy rate, I believe, before we started to see an acceleration in the unemployment rate. And what's interesting is now we're sort of around that level, and we've been hovering around it ever since. And I'm just curious, like, how do you utilize that framework that I just described, and what is it telling you?
It's funny because I actually don't. The first is I've been somewhat skeptical of job openings data. It's not. I don't think it's the most. I mean, I know the Fed pays attention to it. I understand why conceptually people are interested, but like my sense is I look at it and I'm most interested in the turnover numbers, because in the end, like opening is a very ephemeral thing. Like it seems like there may be some structural reasons why that number's gone up, and like it's still fairly high by historical standards, even as the labor market other measures are below. And so I'm just like, I don't know how much weight I put on it, but I think just generally it's an okay conceptual framework. It's reasonable. Waller nailed that specific aspect, and then all of a sudden, sometime in like 23, we started moving to like a more diagonal version. People are like, oh boy, like,
Here it
this is
comes.
it. People were like, Guy wants to. And I always thought it was a weird. I mean, first, it's not good to be on that part, and definitely not good to be moving down and to the right. But what was interesting to me about that argument was like, there's no guarantee that the Beveridge curve is not like some sort of directional thing where like once you start moving, you inevitably like, it's just a description of where you are along that trade-off. I mean, you could start moving up and like you could start sliding down diagonal thing and then something changes and you start moving up and to the left. What's weird is we kind of went through this phase in 23, 24 where the unemployment went up, openings went down, and we were kind of sliding to the right, and we just kind of stopped. It's funny. I have this Beveridge curve chart that I periodically share, and I kind of stopped updating it because there's this big blob that we've been stuck in for about a year, where it's not. Again, we sort of have moved a little bit down and to the right, and then we just kind of stopped. We didn't like do this thing that people were worried about last summer when the Fed started easing, which was we were going to head to the really horizontal part of it, where openings, in fact, are not even coming down that much, and the unemployment rate starts rocketing up. It's just, I mean, again, it's a useful, I think it is an okay framework. We're sort of thinking about, are we in the painless phase of reducing job openings? Are we in a phase where, in fact, even minor tweaks in labor demand can cause huge fluctuations in unemployment? And I think right now we're in a phase where small change, like it's sort of small, like let's call it, changes in labor demand will cause roughly proportional changes in unemployment. And I think the weird thing, again, the openings, I said I don't look at them, but I have bothered to looking at them like, are they telling us a different story than hiring and quits? And they're not. I mean, openings have kind of their decline has either stopped or slowed by a lot over the past year.
Okay, so last big bucket I want to talk about is this business headcount survey and hiring plans, which you just wrote a piece on it on Substack, which has some really good charts that check this out further. But I think that segues nicely into starting to understand where you think the labor market data goes from here, because part of that survey is looking forward as opposed to just what's been happening. So yeah, what do you look at there, and what's your read as it
Yeah.
stands?
So the first thing is like if you're somebody who follows the ISM and the PMIs, like this survey is similar. It doesn't exactly ask it, but it's the same kind of thing. They ask businesses all sorts of questions. They ask them. I use this survey for AI adoption, like that kind of thing too. It's very useful for that, by the way. And I hope they don't discontinue it. Maybe this will fly under the radar, even and it's a census, so who knows. But I think the main reason I'm interested in, and I'm interested in all these surveys, this one's nice because by the government, the data is publicly available. I don't have to kind of like decide, how I'm going to modify the data that much. Whereas like if you're combining like Philly Fed and Empire and ISM, it starts being a little messier. But it's not the only one I follow, but I just ask these questions pretty consistently over time. And like I've been interested a lot in the hiring plans data because it's like I think it's asking a very specific question. Like, do you expect your headcount to expand or decrease in 6 months? Now, I started paying a lot of attention to it last fall when it looked like it was picking up, and I was like, is this indicative of a pickup in headcount? Did not happen, by the way. It was the weird thing, and then all of a sudden, people started figuring out tariffs, and it tanked. And at that point, I'm like, are they going to start cutting headcount? And they didn't. And I think the one thing it kind of made me realize and change sort of my perspective on some of these surveys and forward-looking things is like it's one thing to say you're going to do something in 6 months. A lot of stuff can happen in 6 months. My general feeling is I would expect that maybe if you're extended period, you're pessimistic what's going to happen in the future, they'll eventually turn to action. But like some of it's just sentiment about the future is going to fluctuate a lot more wildly than whatever you do. Um, More recently, the weird part is that survey's been a little more upbeat, and I do not know how much weight I want to put on it. But again, it's not the only data point. Like again, if you want to, if you were a cherry picker, you could find data in the jobs data right now that would tell like a upbeat story. I do not think anybody should do that because I think it's worth looking at holistically. But I don't think it's this kind of thing where like everything's doom and gloom. Like we were worried about the continue. We jump back to continuing claims. We were worried about it. I
Yeah,
was
that's
worried about
grinding
it.
up.
I was
Yeah.
setting very pessimistic things, and then all of a sudden it's become a little less pessimistic, or in fact, substantially less pessimistic. It's still like not great, but I'm like, you know what? It shifted, and I think that's sort of with this survey is I think what it's telling us is if we were, and there's other things by the way, like the businesses are different sizes, smaller. If smaller businesses are more upbeat, the survey will send an upbeat message, and it, despite that, all the big businesses that employ more people are shining workers. Then you're gonna like this survey is gonna be too upbeat. Lots of caveats, but I do think it's interesting. Like again, I don't see stuff in this survey that tells me like, man, businesses have sort of turned a corner. If anything, what surprised me is it's actually the most recent print. We get another one in 2 days, but like was a little more upbeat. Like for a change, their recent they asked them also what have you done the last 2 weeks, and their recent employment actions have been a little more upbeat than they were a year ago, which is unusual for the history of this survey. It hasn't run for that long. Um, and so again, what I look at, it's a useful bit of data. It asks a lot of details in a consistent way. I don't do industry deep dives usually on it, but they exist. And I think it's a nice little barometer. And again, if you're interested in AI adoption, you're getting data from this survey every 2 weeks, including by firm size. So like I would tell you that if you are interested in that kind of stuff, I would look. And again, I actually think the survey might be just an index that's useful, but it could be undercounting it because one of my theories based on looking at that survey is that a lot of businesses don't actually know what their employees are doing, whether they're using it or not. But it's still like it picks up adoption. It has an industry grade in adoption. So I think it's a nice survey to look at. And I look at it pretty regularly. And it's also somewhat more timely than a lot of the other monthly surveys, right? We have for ISM or for market, we have that market, I guess, comes out, which is a great survey. Like, the market surveys are great. They come out, like the preliminary thing comes out like maybe 2/3 of the way through the month. And like we already have data that was collected just a few days ago when this survey comes out every 2 weeks. It's nice.
Yeah, super cool. Bringing this home here, what is your view on the labor market based on everything we talked about? Is it cooling? Is it heating up? Do you think the Fed should be cutting based on like the market sort of thinking ever since that jobs report last week? What's your high level view?
I'll give you my high level views. I think it's been pretty stable recently. And like again, it's a surprise. Like anybody who reads it, like talks to me on Twitter, like I mean, I'm routinely conceding. I thought it'd be weakening. My gut is still that the weakening impulses will eventually kick in. And then maybe like a back half of this story thing. It does not, by the way, mean recession. It just mean like a slow bleed where it creeps up, hiring and quits start drifting down again. Um, But my bans on that are really big. Like, there are these forces squeezing labor demand, squeezing labor supply. Like at any given point, one of them get very powerful and swing the labor market in a certain direction. Do I expect the labor market is going to be cooler? Yes, I think that's probably a good base case. But like, there's this big tail that includes both the labor market just continues being stable, and a chunk of that tail that actually says labor market starts heating up again because there's so few workers that employers are scrambling for them. When you look at some of the industries that have been hit by immigration, again, this is a sector, so it's not the whole economy, but like hotels and restaurants, that looks like a sector that's actually experiencing renewed reheating because I'm guessing they just have fewer, they rely on immigrant labor, both, documented and non-documented, and that taps have been turned off. So could this be eventually big enough to move the labor market in the direction? I think you should definitely consider that possibility. There are other sectors where this won't be relevant because they don't really rely on immigrant labor, and all they're suffering from is, their sector being squeezed by tariffs or by high interest rates. So my feeling is like, I'm not a Fed guy. I'm always like have to think about it. People that are listening to this probably think a lot more about the Fed than I do. But like, I think, let me say this way. I think the Fed may get pressured into it. I don't know, how they may just feel like we have to throw a bone. Maybe we agree with Waller and like downside risks of the labor market have increased and we have to look past inflation. It is not unreasonable to look past tariff cost inflation. The Fed has papers saying that. I do think that if inflation does not improve dramatically, and if the labor market doesn't stay concerned for the worse, the amount of easing that's going to happen is going to be small. Because, like, again, this isn't, you would need a sharp deterioration of the labor market or a big improvement in inflation to allow rates to move a lot, like policy rates to move a lot. Like, it's just like you might get some token easing to move a little bit more toward neutral, but not more than that until the data clearly improves. And even that might not happen.
Yeah, totally. Awesome. Well, look, I appreciate you walking us through all of that. That was a busy hour, but we did
It was
good.
awesome.
Really
Thank you for
appreciate it.
having me.
Yeah. Yeah, likewise. Where can folks go if they want to see more of your work?
So I have a Substack. It's called Macro Mostly, substack.com. I'm also active on LinkedIn. I'm active on Twitter, Blue Sky, LinkedIn. Yeah, those are the places to go. And then occasionally, if you're cracking open the Journal or New York Times or listening to Marketplace, you may hear me pop up.
Cool. Amazing. All right. Well, thanks again for joining. Appreciate that.
Sure. Thanks, Felix.